Hello everyone, my name is Kamal Manocha. I represent PMS AIF World Platform. We have created this platform with a very honest endeavor to try and add value to the wealth management industry by trying to transform the wealth management industry from the processes of sales driven methods to knowledge driven methods. All the more because wealth management industry is centered around investors, and most of the investor returns are kind of decided by their behavior, and behavior kind of depends upon emotions, and emotions are tackled with knowledge. And that is where we thought of conceptualizing weekly webinars in 2018 when we had set this up. There was no COVID then. People did not know about Zoom. People did not know about Webinar Jam and these things. But we discovered them. Many people have been copying us lately. We really like them. We really love them. But at the same time, we try to innovate and try to kind of find answers to realistic questions, by bringing realistic fund managers. Today, because we know equity markets are again going through some tough phase, and though equity markets in terms of valuations look very attractive, but at the same time we do not know whether we can use this word very attractive or not. But yes, though data does convey that, but we have a tough fund manager today who is not just a thinker, who is somebody who has executed over last decade, more than a decade, by giving a multiple of more than 10x returns for his clients, for himself. Brings with him more than 2 decades of experience, did his masters in finance in year 2000, and then obviously he has been doing his entrepreneurship in the name of Purnartha Investment Advisors. Today, Purnartha has evolved to a conglomerate which is not just having an advisory product, but a PMS as well as AI products also. And Rahul Rathi is the chairman of that institution. So welcome Rahul to our weekly Friday webinar. And today we know markets are going through tough times again. And every time when markets go through tough times, investors feel, and I am myself an investor, we feel that maybe this time is different. And that kind of makes one all the more feel fearful that maybe I am unlucky one today when I am sitting on liquidity and I want to invest, or maybe I have invested a couple of years ago, but for me markets are today different. My time is kind of not that fortunate. This is the first thought which comes to most investors when they are kind of adopting equities, especially the ones who have not had a success of making money from equities like you. Obviously there are a mix of investors who have made money in equity markets, who have 2 decades or 3 decades of experience, but mostly we know that equity markets have attracted many new investors over last 3-4 years. That is why it is all the more important for thought leaders like you and a platform like us who's trying to build thought leadership around answering some of these realistic questions. And that is where we first want to hear from you. What are your views about the current equity market scenario? Is it a time to invest into equity markets? Should they be seen opportunistically, or you have different views?
Hi, Kamal, and all the participants of this call. It's a pleasure to be here today with you and interact with you through Kamal or through Q&A. I think let me start with the first question by a background about some of the data points which I'll talk about, and then we can decide why my conclusion is the way it is. So there are two parts to investments. The first part is the economic side or the business side of things. If you look at data on the ground, what we hear about is two parts. First is inflation, second part is interest rates going up. But in spite of both things happening for this year, the number that matters really is GDP growth of the country. And depending on which side of the bed you get up from, you will hear a GDP growth which is between 6 or 8%. If you're an optimist, you'll say 8%. If you're a pessimist, you'll say 6%. Kamal, 6 to 8% for any Indian entrepreneur is par for the course, which means that all the economic ups and downs that you hear, ultimately it all consolidates into one number, which is the real GDP growth number. And this GDP growth number is between 6.5, 7%. And you can see that in capex in manufacturing, you can see that on the activities on the ground. What has changed today from the last 2 years is that not every person which was going very well in the pandemic because of liquidity, so there were a lot of haves and a few have nots. Between 6 to 8%, what you have is a equilibrium between the haves and the have nots. So it's not that everybody is doing well. Some people are doing well, some people are not doing well. And this is par for India over a longer period of time. Nothing really has changed on the GDP growth level. Where things have changed significantly is in terms of flow of money. You look at India as an asset class, and you look at two major participants in the investment phase. One are DIIs and FIIs. And what you see is that the DIIs are buying every single day and the FIIs are selling every single day. This is dysfunctional. It can't happen that I have such polarized views about the same opportunity between people who live in different areas geographically. So what's really happening is that there is a viewpoint outside India that India is a sell, and there is a view within India that India is a buy. And where this stems from, Kamal, is the fact that, when I look at people outside India or talk to people outside India, their factor of safety is valuation. And they look at relative valuations across Asia, across the basket that they want to buy outside their geography. And in India, our factor of safety, because valuations are at a certain level and relatively expensive compared to the Asian markets, our factor of safety is not valuation but operating excellence. So we talk about operating leverage. We try and defend it through some of the operating metrics that we have. So what's happened is that people outside a disconnect. The second part is that the interest rates that are going up globally also means at some point in time, some of the large institutions will do asset allocation in favor of debt compared to equity, as you start seeing a certain interest rate and a certain returns from debt. So some part of the money flowing out is also because of asset allocation. What this really means, so these are the two data points that I looked at, and my analysis out of combining both the data points is that in the next few months you will be able to buy businesses that one likes at prices that one likes also.
Sure, Rahul. Particularly with regards to the IT sector, I can tell you till 6 months ago, we did our annual event, and there were various fund managers, thought leaders who were here trying to propose that IT sector is the top-notch sector for next 5 years because the profit pools of IT companies and IT businesses is expected to rise. At one part, at on one side, the profit pools are definitely rising, the order books are rising, but the stock prices for IT companies have actually fallen more than 20-25%. And you have kind of mentioned that the problem in equity market today is more to do with liquidity and change in the asset allocation. But particularly with regards to IT as a sector, is it only because of these two factors that prices have been falling, or is there anything else that equity market is worrisome about which we need to understand?
Yeah, it is those two factors. And if you look at the quarterly earnings and you look at other things and you look at what, why are people selling, if the operating data on the ground, so nobody disagrees across the fund management people, across geographies, nobody disagrees on the economic side of things. There is a certain level of agreement on the economic side of things. The disagreement really is on the valuation side of things.
At present, what is your view on the valuations with regards to IT as a sector?
I think mid cap IT is expensive. So if you look at right from 2005 to today, large cap IT, and if you look at Microsoft, if you look at Accenture, the valuations are comparable.
Sure.
So mid cap is expensive, large cap is within the same zone of what US valuations are.
One
Yeah,
of the,
there is a question around transmission not clear. Is it my side? Can you hear me?
transmission is clear.
Transmission is clear.
Yeah,
All
it's
right.
clear.
Thank you.
So, next question which comes to my mind is with regards to one of the top stocks, top holdings, in your portfolio since last, I would say 8, 9 years, which is Bajaj Finance. Every time when Bajaj Finance falls, many investors see it as an opportunity. And every time, when Bajaj Finance falls, it actually shows a trend of falling more than the markets. At present, again, Bajaj Finance has fallen from levels of 8,000 to around 5,000. But at the same time, we are not wanting you to give a comment on the stock price because we understand, obviously, that is something which you may not want to comment upon. However, with regards to the business, because yours is a research backed advisory. In that context, where do you see Bajaj Finance as a business going, given the rise in interest rates, which have on one side maybe a positive angle in terms of rise in margins, but at the same time, because of rise in interest rates, there will be a squeeze in the demand, and purchasing power may also be reduced, at a consumer level because of rise in inflation, and competition is also rising. So, what are your comments on Bajaj Finance as a business, given the current valuations?
Yeah. So I think that the demand for capital, if India is growing at 6% GDP growth, will be at 10 to 11%. So, come what may, and the demand can come from many sectors because of inflation. Demand also comes from SMEs. And given that capex is happening in manufacturing, there will be certain working capital requirements that will come. So, my expectation really is that credit growth will continue to happen. It might not be similar as it happened in consumers. There could be other sectors that will pick up as manufacturing picks up and other things pick up. So my expectation is Bajaj Finance will continue to, they have, because they have several growth engines, they will continue to grow at a certain pace, and their ability to spot opportunities, build the right risk framework, and continue to lend given the opportunities that are existing in the market means that they will be faster on the pivot compared to most people if there is a need to pivot. So on the business front, on the business side of things are really good.
Sure. Your basket of stocks have mostly been very concentrated, but now going forward, given the fact that all of us believe that India's economy is kind of in a golden phase over next 5 to 7 years. In last 10 years, from 2010 to 2020, the GDP numbers were degrowing. But you also started your conversation by being very confident about the GDP growth, and we have been seeing estimates of India getting added into 5 trillion GDP mark in this decade. So given that there will be a massive addition to GDP, the micro side of India's economy is healthy. You still want to remain concentrated, or you see more sectors or more stocks, more businesses getting added to your strategy?
We do see more businesses getting added to the strategy as we see a lot of more capable managements coming to the market, and there is always an opportunity to buy good businesses and hold them for times to come. So, yeah, we do expect to build our portfolio growing forward.
So, can you please elaborate what do you mean by new and capable managements coming? Are you talking about the new age businesses, or
New age businesses or existing businesses where there is a technology transformation? And an example of existing businesses where there's a technology transformation could be, EVs, like what's happening at Tata Motors, other, mobility solutions. And you'll see opportunities stemming out of that. Renewable energy is an old sector where renewable is becoming a sector of tomorrow. So you will see opportunities coming out of that.
some of the stocks that you have exited in the past, like Maruti, like Whirlpool, now after correction, and since some of these stocks have not participated in the past rally, and there is always, a kind of a new learning and new things that happen in the equity markets. Do you want to see and look back to some of those stocks at these levels?
So nothing is off the table, right, Kamal? At every levels, something or the other is attractive. What So there are two parts to a business being added to the portfolio. The first part is that there is a certainty of change in the future versus history. So history gives you a certain confidence of the business being sustainable, but future gives you the confidence of saying that which part of history will ensure that it continues to grow itself into a different level. So balancing both are critical to be able to ensure that even if you're wrong, you protect capital. So the history tells you what the factor of safety is, and your analysis of the future tells you how much money you will make.
So your answer is, I am unable to understand with regards to your older sell stocks. You would want to consider
So
them.
if there is, yeah, but so the history is okay, right? It's not that good. But what about the future will change, which is not similar to history? And if we know what can change and what are the engines of that change, and we see that somewhere in the recent history, then only will we say, yes, we will buy into them.
Sure, sure. Because your competence and your forte in terms of identifying capable managements, is something that you commented about. And Maruti and Whirlpool are two stocks which I can see many investors, because it happens in the world of advisory. When you give advice, many investors tend to still kind of keep them in the separate bucket. They may not have exited, and they contact us. They try to find answers from us. We have particularly received this question, from some of those investors who, despite having subscribed to your advisory, have not kind of acted in terms of selling some of these stocks. But now, obviously, there are many other companies which are also attractively available within the same bucket. So they want to ask you this question: would you want to go back to these picks or not?
Currently, no.
Sure. We have always seen in the past that interest rate as a cycle plays out. This time again, when you started a conversation, you mentioned that liquidity is the one which is kind of adding kind of different sentiment to the equity markets, which is led by the interest rate cycle. do you see this time the interest rate cycle is a longish cycle or a kind of a very short-lived cycle, or it is different than the way it has behaved in the past?
So, Kamal, I think the answer will be in the November Fed, uh, the November Fed outlook. So, currently there are elections till November, the midterm elections in the US, and that will drive some of the policy decisions of the Fed between now and November. November is where they will talk about growth versus interest rates. Right now, they are only talking about inflation. Jerome Powell made a fleeting comment on to kind of asset markets, but it didn't work. So the data will come in the November Fed outlook. Right now, it's all political.
Right. You have been managing, advisory as well as PMS and as well as AIF. Now, hand on your heart, if you have to advise an HNI client who can afford to do all three buckets, how would you kind of, put yourself in investor's shoe and advise him that, which structure should he go for?
I think this is the market to be nimble. Very important to be able to execute given that flows are so dynamic. I think right now the PMS structure works really well, because you have to be nimble. I think the opportunity on the buying side will come in the PMS, and the execution on the PMS. What we have seen even in Whirlpool is that execution on PMS was far better than existing clients doing things, because you know in the existing clients they might not be on the table at the time when you are looking at things. So my suggestion would be starting with PMS, then the AF structure, and then the advisory structure.
No, I agree with you. Thank you so much for this insight. Besides some of the well-known risks, which are kind of today circulating around liquidity, interest rates, inflation, and macro scenario, are there any unknown risks which somewhere are there back of your subconsciousness, back of your mind, which may play out and which investors should be wary of while today deciding to take calls of investing into equities asset class?
Yeah, I think Kamal, the biggest thing that we did in our portfolio is avoid liquidity risk, because you've seen it in 2017. It played out in Porenjo's portfolio, and for people who have been there in 2008, it was even a bigger thing that was there, that people created side pockets because they could not sell. If you look at our current portfolio, we have sacrificed returns or returns potential for liquidity. We did not want to take any liquidity risk. And I think the next 1 to 2 years, people are going to be talking about liquidity risk. And the reason why I mentioned this today is just because of polarization of people looking at the same asset class based on geography.
So Rahul, can you please explain, your
Liquidity
ideology?
risk is the risk that if you want to sell your positions, is there a buyer on the other side? And if there's no buyer, it's illiquid, right? It's like real estate in some time when there was no buyer at a point in time.
So by saying so, you are trying to convey that you prefer to remain in the large cap side of equity markets.
Yeah.
Sure, understood. The golden question, which today everybody has in their mind, and it is getting all the more questioned, is that are we really in the golden phase of India as an economy? Because today, when anybody is trying to make a bet on equities in asset class and see this time as an opportunist time, he would want to know or she would want to know whether India is really into the golden decade. There have been prominent fund houses who have been coming up with funds by name Golden Decade Fund, because obviously, we all of us have been talking about this decade, which started, after the fall in interest rates, where GDP numbers started going up. Again, corporate earnings have been going up. We have been waiting for corporate earnings to participate. For last almost, I would say, 7 quarters, corporate earnings have shown resilience and they have shown the trend of growth. Various, engines of growth, various economic factors are conveying that India's economy is kind of showing a lot of growth in terms of rise in ultimately GDP. But will this continue over next 5 years? And do you really see, this kind of getting and showing multiplier impact over this decade?
I think I think that if I look at the data, what I really see is that India is a stock pickers market. So there are times when everything does well, and there are times when everything does badly. And these are two extremes, and the middle is companies that have good operating history continue to do well. I think if I break 11 years, there will be 2 years when everything does well. It doesn't matter what you pick, everything will do well. And there are 2 years when everything does badly. It doesn't matter what you pick. You've picked up an absolute beauty and it will still do badly. And those leaving those 4 years, there are 7 years where logic continues to, you know, be the underlying factor in doing well. I think that we are in times of these extremities, and to kind of take a data point from these extreme scenarios and pull it towards a logical conclusion would not be fair to larger data sets. So, Kamal, the suggestion really is that, look at a longer history, and India is going to be a stock pickers market, and stocks will continue to do well. So, stock pickers will continue to do well. We are not a macro market where there is a consistent certain level of growth that continues across the sectors. And if you look at 2010 to 2022, a great example is cyclicals. For a long time, the cyclicals just did not move. And then 2, 3 years, they did extremely well. And because they were part of the index, they suddenly did well. Reliance didn't move for a long time and suddenly it did well. So you got to isolate these one-off behaviors and then look at, the meat of your investment time, and that's a stock pickers market. It's not everything does badly or everything does well kind of a market.
Right. Very interesting. With regards to some of the new ideas that you may want to add into your portfolio given the current correction amongst new age and old age businesses, do you want to throw lights on some of the sectors or some of the business models from where they would emerge, or something which you are seeing currently which is looking attractive to you, and you may want to discuss that in terms of the ideology or a business model?
So the way we are looking at it, Kamal, is there are about 13 to 14 businesses that we like. And what we think is that within those 14 businesses, we'll get 4 or 5 businesses at the price we like to. And we'll add those to the portfolio. So instead of just adding businesses at any price, We'll just wait for what we believe is a golden price. And what I think is there is a pendulum going on. So we saw it swing to extreme right, and you can see it in terms of valuations. And we think that the pendulum for some of the businesses will swing to extreme left. And those are the times that we'll buy those. So I think in the next 5 months or 4 months, you will be able to get businesses that you like at the prices that you like. And you can't be choosy saying that I want to buy this business only. I think what we have done is we have looked at 13 or 14 businesses and said that these are great businesses, good businesses, and at these price are very, very attractive.
So how much more pain do you see, or the possibility of fall do you see in terms of percentage in the prices, say on an average in those 13 businesses over next 5 months?
Oh, if any of them falls 25 to 30% more, we'll buy them. We'll wait. We don't mind waiting.
Sure. So
You know,
basically, through this conversation, I'm trying to understand that your view is at the moment kind of cautious. You're not being too optimistic in terms of.
no, I'm actually being bullish, saying that I will get opportunities because of liquidity risk. So I'm on the other side of the fence because I'm on a liquid portfolio. I can afford to be opportunistic. So it's every person has a different environment, right, Kamal?
Right. So in terms of asset allocation, what would you advise an investor at the age of say 35 to 45 at the current valuations of market at current levels? How much, if he's sitting on 100 rupee as a fresh liquidity to be invested into equities and is currently already kind of 70% into equities, how should he allocate that fresh 100 rupees at current levels?
Um, the first thing, Kamal, is try and identify what the liquidity risk in the portfolio is and try and see that he kind of reduces liquidity risk in the portfolio. So, other than that, it's an individual choice depending on what he has and what is the factor of safety that the individual believes in. But really think about liquidity risk also. Because when he wants to switch, if there's nobody to buy the current thing to switch, then that's a problem, right?
So if I try and put myself in investor's shoe, I think the realistic problem thinking that way would be that if you try to focus on liquidity risk and try to kind of protect your portfolio by being into very liquid businesses, you will end up owning highly valued businesses. And when we have recently seen that valuation is being questioned, and that is because of liquidity risk, don't you think that can kind of lead to a vicious problem?
No, liquidity risk and valuation risks are two different things.
So,
What
can you
what
please explain, your
what is
argument by
what is
taking an
what is
example?
liquidity risk is that there are no buyers for the businesses that you want. So you have side pockets. Valuation risk is really a risk where there could be a time correction because of valuation. So earnings are growing at 50%, but the stock does not move in price even though earnings are growing at 50%. And that's a time correction risk. That's not a liquidity risk. If I want to liquidate Bajaj Finance, if I want to liquidate Tata Consumer, if I want to liquidate DMart, if I want to liquidate ICICI Bank and HDFC Bank and other things, you'll be able to liquidate it within 3 days,
Right,
whatever your position.
right.
But if I have a large position where liquidity is a challenge, there's no buyer on the other side.
But today, if I try to address that risk in one's portfolio, say in my portfolio, and I try and reduce some of the businesses where there could be a liquidity risk in the future, and convert them into something like DMart, then the valuation of my portfolio will also go up.
Correct. So
So
wait for the next 6 months. You will you What will happen is that you don't look at a DMart, right? You look at 14 businesses and buy the business that comes to a valuation that is attractive. What I'm saying is that liquidity risk will create opportunities.
understood.
It's just the nature of the game, right? That everybody for the last 12 years or 14 years, we didn't have to focus on liquidity risk because the Fed provided liquidity. So it never was important. 2008 was a liquidity crisis. And what did the Fed do? They started printing money to provide liquidity, which means that every toxic asset that you had a chance to sell it to the government. What's happening right now is the government is taking away liquidity. So the last 14 years, you never had a liquidity risk. And I think that some of it will play out, and I hope a lot of it doesn't play out. But if it plays out, it could be an opportunity. What I'm saying is that, you look at so many people that have to sell their family jewelry because they were in stress, because that was liquid, because the toxic things were not liquid. And I'm going to sit on cash to buy great businesses at good valuations. And because my portfolio is liquid, and that's my strategy, right? Everybody has different strategies based on the style that they have.
Last 10 years, when equity markets were driven and maybe were kind of made to rise by pumping in liquidity, as you mentioned, some of the businesses which actually grew in terms of earnings all or, outshined all the more, and some of those concentrated businesses created wealth in your portfolio and many other portfolios. So this point is well understood. Now, in the next 10 years, obviously, when the liquidity risk emerges, and if we assume that the markets kind of are made to survive with the very, I would say, weak liquidity or with very select liquidity, and at the same time, this is a phase for India's economy to kind of show some kind of growth, which I think you kind of, as mentioned, that you do not completely agree with, because you mentioned this is more of a stock pickers capital market. India as a capital market. So keeping these two thoughts in mind, what are the businesses, what are the sectors, whether it be a real estate or equity as an asset class, or within equity, maybe real estate side of businesses, what businesses come to your mind which are relatively more safe and which are not too much dependent on liquidity?
Oh, banking is a great business, right? Banking is right up there. India's GDP per capita is $2,300. You know, everybody requires banking services to continue to grow. So, banking, we have a sweet spot. There are multiple businesses where there is a sweet spot in some sense, and you have to pick up the right businesses, and you'll do well. So I think financial services will continue to do well. And I'm sure, Kamal, everybody's talking the same thing, is that, if I look at the current basket, everybody will come up with the same names. But what I'm saying is that you will always find pockets of opportunity. And the opportunity over the next 5 months will be far more stark because of just tightening of liquidity. Otherwise, we have this talk next year, and we'll be talking about the same things in terms of which businesses to pick up, what do you do, how much cash do you keep. But the difference will be that the markets might not have moved like it did in the last 2 or 3 years. You might have individual outperformers or individual laggards, but I think the market will drift.
Given your 2 decades of experience, what do you see this kind of a correction which is going on, which is already kind of become more than 15%? Will it kind of get dragged to more than 25 or 30% because of the liquidity risk,
I
or it
don't
will?
know, Kamal. Kamal, that's a tough question to answer because the governments are, or the US Fed is focused solely on inflation, and they have kind of said that this is the reason why they're focusing on inflation. So their actions to suck out liquidity is to kill inflation, which is also their mandate, but it's also a politically driven thing. It need not be logical, Kamal. Today, so if you ask any fund manager and you ask them that growth versus, a recession, you'll get the answer 100% as growth, right? I don't know anybody who likes a recession, right? But that's not what the US Fed is saying. The US Fed is saying we will increase interest rates, and if there is some collateral damage, so be it. Is that logical? No. Is that politically motivated? Yes. Can I apply certain logic to it? No. So what do? I sit on cash. So currently, the only experience that I have, and really, I can read a lot of the chats here and happy to answer all the questions. But Kamal, the big thing that I learned from 2008, having been present then, is that there was liquidity risk, and that was part of the decision making. In the last 14 years, there has been no liquidity risk because of money being printed. And I think in the next few months, that might play up, and it might not. If I'm wrong, I'm not losing anything. If I'm right, I'll make a lot of money. But it's the situation that I'm in. If somebody else is today saying that they look at it historically, they don't see any liquidity risk, they'll say, oh, it's fallen 20%. I'll tell you the markets in 2007, and I'm sorry to go back. The markets in 2007 were trading at 20 times, 21 times. What were the markets in 2008 trading at 10 times? Was 20 times also 20% lower? Yes. But I don't think the markets are going there. Let me say that this is an example. What I'm saying is that in the next 6 months, be aware of it. It has nothing to say that it might play out, might not play out. As long as you're aware of it, that's good enough. Then how you act on it, if you act on it, if there is a need to act on it, is different. But last 14 years, you have not seen that. That's all. And I'm not being an alarmist, I'm just being an opportunist. Again, the idea is there. And Anand asked a question that, worthwhile to taking funds on interest at 9% and deploying those funds in equity in a staggered manner for better returns? Absolutely not. I would never, there is a period of uncertainty today. And what I'm saying is be conservative, not aggressive today. Because irrationality is part of the markets and they can remain irrational longer than our emotional capability. So, liquidity risk is also emotional in some sense when everybody as a herd decides that they don't want to participate, or everybody as a herd decides to participate. It can't happen, Kamal, that looking at the same business, FIs continue to pull out every single month and DIs continue to buy every single month. It means that there is some dysfunctionality. You can't have polarized views. Market means that today I decide to sell, tomorrow I decide to buy. It can't happen that I have only one view. So my point is, is that look at the data, which is not in the immediate past, a little longer data, and be aware of some of the risks that have not been there in the last 14 years. Yeah.
So how, I would say, how should one comprehend, this liquidity risk, since this risk has not been there in the practical experience of various investors and fund managers over last 10 to 14 years. Today we are kind of being not alarmed, but opportunistically being poked by your speech that if one is aware of this risk, one can keep some, gunpowder ready. When this risk plays, one can take to one's advantage. So I understand, that message. But how should one comprehend this risk? How worse can this risk go? And
Not about worse. So how do you look at it, right? ICICI has this asset allocation fund. It gives a good directional thing of where the risks are. So it balances between equity and debt, and it has a certain model depending on PE, price to book, market cap to GDP, and bond yields. I think there are four parameters, and they do a certain assessment, and that fund is a very good indicator of where the risks are in terms of quantifying. They've done one particular thing. Use that fund, and it does capture in some sense some kind of liquidity risk through the bond premiums that there are. But yeah, so that's where it is, Kamal.
sure. So, your portfolio primarily in the past I have seen has been trying to get, take advantage of some of the businesses which are showing, consistent volume growth, are contributing to the macro, contributing to the GDP growth of the economy, are led by capable managements, have high skin in the game, have higher return on capital employed. So your method and your formula, which has been working over last 12 years, has that also evolved? And have you added, any new layer of filtration to your style in terms of valuations or, in terms of any other aspect?
Kamal, right now, these are not times to look at the business side of things. Like I said, one part of managing money is the business side of things. The other side is also understanding the fund flow. And this is a time to be aware of how funds are flowing. If there is divergence on the views of fund flow, then be aware of it. So for example, Anand mentions that borrow money at 9%. Are there debt opportunities at 9.5%? Yes. Think about those and then deploy. I think opportunities have opened up, and know what the opportunities are before deploying money.
I will, reword my question, Rahul. So the thing is, as you very rightly mentioned, that today there is a liquidity risk which one needs to be aware of. Second thing that you mentioned is that out of a say 10-year cycle, especially for India's economy, maybe there will be various ups and downs because of cyclicality of the nature of capital markets in India. But there are some businesses which continue to do well, and it is important to identify and remain invested in those businesses. Now, even in the next 10 year as a decade, you mentioned that this is the way it will play out because it is the nature of India as a capital market. Today, when liquidity risk throws the opportunity, what are the businesses in that context that were identified, the formula of identifying those businesses that you had kind of derived and that you have been following? Has that formula evolved as the world is evolving in terms of new technologies, in terms of new learnings post COVID, right? And especially when the liquidity risk, which is the new risk, is now coming up, which was not there in last 10 years.
Yeah, that's my point, is that interest rates will give you opportunities that are very different from what were there in the last 14 years. And what I'm saying is that because of that, you will get some things that are, so inflation is a tailwind for the financial sector. Because my FDs are fixed at a certain rate, but my lending rate changes immediately. So there are certain benefits that you have because of the current environment. And out of those benefits and out of the next 6 months, new business models will emerge. And so I think the next 10 years belong to business models. They don't belong to sectors, because the amount of liquidity that has come into the system, if you have the right business model, you will succeed. Retail, for example, I hold DMart. Retail, for example, has been there for years together. I was studying data for Walmart. From 1975 to 2022, Walmart has grown at 25% CAGR. We're talking about 47 years of 25% CAGR. Is retail a new industry? No. Was Walmart's business model different? Yes. So, Kamal, for me and for somebody who loves studying businesses, I think business models will drive wealth creation. I don't think it's a sector that will drive wealth creation. Shree Cement, for example, has created tremendous wealth in cement, which is a commodity. And he wasn't the first one or the last one to do it. Navrattam Sexaria did it earlier in Ambuja. So I'm saying that the next decade belongs to business models, not to sectors. I think every sector that needs to be discovered is discovered. Okay, energy, you'll say renewable energy versus old age energy. It's a technology shift, but it still is energy. And the amount of energy that the world needs has continued to grow over decades. The number of kilometers that every person travels every year has continued to increase. I asked my parents over the last 30 years, what were the kilometers they traveled every day, and the kilometers that I travel every day, there is a marked difference. But given that I travel this much, given that there is technology, does it benefit? For example, you look at somebody like a Zerodha or a Swiggy or others, They've just changed the pace of things. And it's all about business models today. My only thing that why it's going to be concentrated is because of business models. So if I have to bet on something, forget the next 6 months, okay? The next 6 months are volatile, and because of my experience in 2008, I'm going to play that out in a certain way. And that's different, and that's because of my experience there. But let's fast forward to a steady state regime. Okay? To a steady state regime, I'm going to play out business models. What you will see in the portfolio is why business models will continue to deliver a certain higher growth than the market. And an example of a great business model is DMart. An example of a great business model is Bajaj Finance. An example of a great emerging business model is ICICI Bank. Are there small cap, mid cap? Yes, they are there. But it's something that I've not invested in, but we are tracking, and that's where things are.
Sure. So this is the last question, Rahul. You have actually, started a very new and long conversation on which we will have to do maybe another webinar on business models. But before we end, I would want you to kind of forget equity markets, forget liquidity risk, and just think as an entrepreneur and apply your entrepreneurship skills theoretically and practically, and try and explain to the audience and to me that what is it that makes Bajaj Finance an excellent business model, or an Avenue Supermart an excellent business model, versus the older way of doing things?
So let's talk about DMart, right? If there are a few clients here, they would have heard this story. But Kamal, if you had to buy bread, and you go to a baker and he tells you this is bread baked today, and it's 20 rupees, and this is bread baked yesterday, which is 14 rupees, which one would you buy?
The one which is fresh.
So you're willing to pay a premium, and the date of packing determines quality, for quality, which is date of packing. DMart has built in a business model, and the way they've done it is saying that they tell their suppliers that we'll pay you within 7 days. But your next order will depend on whether all the SKUs are over or not. And if they're not over, they don't get the next order. Getting paid in 7 days in a sector that gets paid in 60 days is a phenomenal thing. But really, they built this as a business model so that because of paying in 7 days, they keep on getting fresher material. And that's what drives repeat purchases. And I won't talk about this in an open forum, but okay, Kamal, let's say you want to buy 3,500 crores of real estate across 180 locations. Can you do it alone?
No.
Okay, so if you have people who are doing this for you, how much leakage will be there?
I have no idea.
Can you imagine that there'll be leakage? Because if I have a property that I want to sell, and I might be able to ensure that it gets bought, right? That is why DMart's competitors do not buy real estate. But DMart has found a model to buy real estate without any leakage. Do you know why? Because all the top 3 decision makers have more than 150 crores of stock of DMart. Because they are incentivized to ensure that the stock value goes up, any leakage is meaningless to them. So Kamal, there are moats that you create. Okay, and why is this important, Kamal? I'll tell you. Is, let's say you have two stores, one you own versus your competitor who rents a store. 5 years later, which one will have lesser cost of operations?
Depends, whether rent
If you
is.
own the store, you'll have a lesser cost of operation because you're not paying rent with inflation, right? And if you own the store, you've optimized all the things for cost optimization.
But there is an opportunity cost also of the money that would have been invested into real estate.
Yeah, we
That
are
would have
talking
been.
about cost of operations. So
No.
you're talking about opportunity cost. That's the second part. But if I buy real estate and 5 years later I can price myself lower than competitors because my costs are lower,
Right.
I will be the last man standing in tough times. So you create multiple hooks in the business model.
Right.
It's very difficult for people to compete with buying real estate to reduce their cost of ownership. It's very, very difficult in India. And to have 3,500 crores of real estate without leakage is an unbelievable business model. So, and I can talk about multiple businesses this way. For lack of time, we'll not get into Bajaj Finance. But Bajaj Finance has the same things in terms of a business model, Kamal. So the beauty, are you, I, can you, yeah, okay.
Yeah, yeah, I can hear you.
So I think the next 10 years, growth will depend on business models. Yeah. And I think value creation will be for business models that create wealth. Do you know gross block to total assets? DMart, although being in retail business, their gross block is 70% of their total assets, which tells you that inventory is so fast moving that there's no dead inventory. How do you do that? It's an unbelievable study of business models.
Right. It has been really insightful and intuitive interacting with you. I have had massive learnings in this session. I'm sure everybody who logged in would have had. We have been able to answer, I think, most of the questions asked by the audience. The crux of our discussion, if I have to sum it up in 2 lines, is that this is the time to be aware, to be cautiously optimistic, and to keep some liquidity to be able to opportunistically handle the liquidity risk which may play, and at the same time look at equities and asset class as an opportunity, because the more the liquidity risk is playing, the more valuations are becoming attractive. And remember that macro may play risks, may throw opportunities, but they ultimately lead to cycles. It is more important to understand underlying businesses and keep focus on some of the business models which are trying to disrupt, which are trying to create moat. And through those business models in a portfolio, one can have a multi-bagger kind of a returns, which Rahul and some of the fund managers have been able to generate over last decade. And obviously, with conviction and perseverance, that can be generated over next decade as well. We will continue our endeavor in terms of trying to bring some of thought leaders during these tough times, as we did during our COVID times. And thank you so much to our dear guest Rahul Rathi for spending time today to share wise thoughts. And thank you everyone for logging in.
Thank you, Kamal. It's a pleasure being with you on this platform. Thank you.